For more Fed reaction, let's turn to Mona Mahajan, Edward Jones Senior Investment Strategist. Mona, let me get your take, first of all, on the news. What did you make of the Fed's decision today? And also, I'm looking at my screen right now. I have green everywhere, Mona. I have 3 indexes all in the green, led, by the way, by the NASDAQ, up about 1.5% right now.
Yeah, one of the things I took away was when Jerome Powell said that there's better balance between raising rates and cutting rates right now. Keep in mind, earlier in the year, he said there's more risk to not doing as much. So his bias was to continue to raise to make sure that inflation headed towards more resolutely that 2% target. Now it feels like the risks are more balanced. There is a risk if they continue at this pace that they could actually hurt the economy. There could be an impact on the consumer consumption broadly, and something in the system may break over time. And so I do think him expressing that better balance between rate cuts and rate hikes implies for the markets that we are closer to the end than we were earlier this year, certainly, and probably going forward as well.
Hey, Mona, it's Julie here. It's good to see you. Balance does seem to be the word. I was hearing this word a lot today, even in advance of the Fed's meeting, right? That there was this expectation that that would be sort of the tone that Jay Powell would try to strike. For lack of a better word, is this good? In other words, is it good that the Fed, if the Fed is indeed done, is it good that they're done? Or is it not good because it implies that we are sort of on a knife's edge here?
Yeah, look, I think looking at the economic backdrop, we certainly aren't seeing any imminent sort of downturn. We got Q3 GDP figures at 4.9%. I mean, really well above trend levels. Granted, that's backward looking. And as we look at the quarters ahead, we are seeing a bit of softness emerge. Certainly the consumer has some emerging headwinds. Not only are rates and mortgage rates elevated, we are also seeing increased bank lending standards, or more tighter bank lending standards. And we're also seeing those excess savings that the consumers had post-pandemic starting to get worked down. So those headwinds are very real, something that the Fed watches closely as well. But, on the other hand, as the consumer potentially softens, as that labor market, as Jerome Powell noted, potentially opens up a bit, cools somewhat, we are likely to see better inflationary trends as well. So not only are we going to see better wage trends, and that would impact core inflation, but over time, we think areas like housing, shelter, rent prices that have decelerated in real time will show up in those CPI baskets with a lag as well. So I think the idea that the economy is cooling just enough to support inflation was a real takeaway. And of course, we do think the Fed does see a end in sight for its rate hiking cycle, especially given what yields are doing in real time and what quantitative tightening has done in real time as well.
So I want to add it up for us in terms of the equity market. Where do you think we're headed in the near to intermediate term? Because there's some challenges perhaps, but also I'm interested in how you think about seasonals. CFRA Sam Stovall reminds us, hey, we're heading into the strongest 6 months of the year. That's what we're staring into. How does that play into your strategy and how you're thinking about where the market heads from here?
Yeah, it's a great point. And look, we just went through a 10% correction in the S&P 500, slightly more in the NASDAQ. And that does tend to be a good starting point, especially as we're heading towards November and December of, year end. And then when you look historically, an interesting fact, since 1990, 11 times that Q3 has been negative as it was this year, 9 of those 11 times ended up positive in Q4 and positive by average of 10.6%. So we are looking at history on our side and potentially very favorably on our side. Now, we'd say is longer term, as we head towards potentially a period of economic softening, you could get volatility along the way, but we are setting up for 2024 that potentially you're looking at better inflation trends, a Fed that has definitively stepped to the sidelines, maybe even thinking about pivoting lower, and by the way, earnings trends that should reaccelerate. So not a bad backdrop heading into year end of 2024 and in year end of 2023 as well.
So you just buy the market and forget about it? Buy the SPY and you're done here, Mona? Or do you think you need to be more choosy and look at specific sectors in this environment?
Yeah, it's a great point. And certainly, this year we've seen just a handful of sectors and, of course, a handful of stocks that have led the market higher. We all know about the Magnificent Seven trade. But as we look forward over the next 12 to 18 months, we do think there will be better balance in market leadership and market participation. So we think while you don't wholesale give up on the AI technology trade, that's probably in the early innings of a long-term bull market itself. we want to make sure our portfolios are diversified with areas like cyclical sectors, parts of the value space, and even small caps and international over time, we think play some catch up here. And then, of course, let's not forget our bond portfolios, which now with better yields and better potential for price appreciation if the Fed pauses and pivots lower, certainly looking more and more attractive.
Mona Mahajan, thank you so much for joining us, Mona.
Thank you, guys.